Welcome to the Founders Chat, where I talk with founders about the hidden moments behind building their companies. I am Alan, former Google engineer, serial entrepreneur, and somebody that knows firsthand how building can get messy. Here we have Rory Semple today. Welcome, Rory.
Thanks for having me.
So tell us, what is Teckel Capital?
Yeah, happy to. So, a little different from, I'm sure, many of your other guests in the sense that there's no real product. The only thing that we would describe as our product is the way that we do trading. So, we're a quantitative trading company. We do what I would call systematic investing. So, systematic investing, I'll define it broadly as using market cycles to position ourselves either for what we believe will be like an upwards trend or a downwards trend. Um, so our product is not like something that we would sell to you. Our product is something that you would invest with us, and then hopefully together we create opportunities to grow your capital. So a little different from a typical founder interview, a little different maybe your typical guest on this podcast. But if you want to think about it, our product is really our algorithm, the way that we invest money.
So it's automated trading. So you have engineers in your team.
Yeah, so I'm actually the engineer in my team. So I think a lot of founders, like you get technical founders and you get like the big idea founders, right? If you want to put them in two broad buckets. And I would be the technical founder. And then my other founder, his name is Matteo Galosci, he's more of the kind of big idea founder. So maybe I'll give you a bit of background and this will help unpack it. Uh, Basically, I've been trading my own capital for years now, and I'd always been relatively successful with it. I went through all sorts of asset types, crypto, Forex. I actually made money in Forex, which is very surprising. Typical public equities, stocks, ETFs, bonds, gold, etc. Right. So I've been trading my own money, and it had done very well. I was very happy with the results, but I never thought about productizing it, if that makes sense.
Yeah.
I just thought about it as a way to do my own thing, run my own money. And I met my co-founder, Matteo, actually at work. And we met at work and he said to me, well, why don't you kind of launch this to more people? Why don't you help manage other people's money? I mean, it seems to be going well. Why don't you do that? So we got together and started Teckel Capital. And that's really kind of the origin story. Every person, I think, has an origin story, but I would say I was the technical guy, the guy who came in with all the ideas and the knowledge of the trading systems. And Mateo was the big idea guy. Like, why don't we bring this to more people? Why don't we make a business out of this?
This leads actually to my next question. I was going to ask you, how did everything started? So you told me a little bit about the story, but where at that point in time, did you have like a job or a 9 to 5 job that you quit, or how did it work?
Yeah, so we met at work. So we were both working at a management consulting company called AT Kearney, now known just as Kearney. We're both in the Atlanta office. I had recently moved to Atlanta, and Matteo had recently joined the firm. And we were at a summer kind of event, happy hour. It was a baseball game. Now, being Scottish originally, I have pretty limited interest in baseball. And Matteo, being Albanian originally, also has pretty limited interest in baseball. So we ended up chatting more than watching the game. And in that conversation, I discovered, Matteo had grown up partially in Albania, but spent a lot of time here. He went to Georgia Tech, which is, the best engineering school in the U.S. And he was just really interested in business. He'd started a tutoring company. He'd done a lot of like little entrepreneurial endeavors along the way. And what he was looking for was someone who I think came with the technical background to really launch like a feasible business idea that was more scalable, that would be more of a path to independence. So to answer your initial question, we were both at Kearney. Laterally, we both joined another consulting company called FTI. We joined FTI, and we are actually still juggling starting a company and full-time employment, which is a fortunate position to be in. And I recognize that that's fortunate. And the reason we can do that is because it is automated, because it is algorithmic, right? We have the ability to spend our nights and spend our weekends on it, but it doesn't absorb the whole day, like how maybe a more product-based startup would absorb your whole day, or something physical, production or manufacturing would absorb your whole day.
Yeah, I know it's challenging. I've done both. It is now, but my last venture, Nexuk, I first quit and then
Yep.
started. But then you have this financial pressure, right?
Mm-hmm.
Kind of this deadline that you need to make it work, or
Yep.
you struggle. And then I've been on the other side as well, and you don't have this deadline, but it can be, you can burn out if you don't make it work fast enough, because working, I don't know how many hours per week, but a full-time job plus starting something is quite brutal, right?
Yeah, I mean, it's not easy. I certainly wouldn't recommend it as a lifestyle choice for the long term, but we're relatively fortunate in that we're on quite intense projects. You're probably familiar with consulting as an industry. It's not a 40-hour a week job. But that said, because everything is relatively automated and we built it to be like scalable and automated in the back end from the very beginning, right? We had that idea right at the beginning.
That's great.
Because we had that idea, we're able to juggle both as of right now. And of course, there will be that inflection point in the future when you're talking about, I'm going to do this full time. That inflection point will come. When it will come, well, that depends on. Unfortunately, it's not like there's upsides and downsides to this being your product. The upside is that you can make it automated, etc. The downside is the markets have to behave, right? So market behavior and capital raising are probably the two biggest factors in when this inflection point will come. But we hope for it to come in the next couple of years.
And is there something about the early story that most people don't know you want to share now?
Yeah, I mean, so I think what most people don't know, or something that we don't talk about maybe often enough, is just the background that kind of got us here, right? I think a lot of people outside in, there's this survivorship bias. So they see successful startups and they think, oh, this is easy, you just come up with a great product, some great branding, and suddenly everyone's gonna be interested in it and become customers in a product sense. I think because there's a survivorship bias and you only really hear about the successful stories, there's a whole lot of stories that are buried underneath that weren't successful, right? And so what I guess probably a lot of people maybe wouldn't understand or haven't heard that much about is it's been a journey to get here, right? I mean, creating sustained market returns that beat the indices oftentimes by multiples is really difficult. It's not something that's easy, right? And to be able to do that, we have to go through a ton of trial and error. So, there are as many dead products, dead algorithms, if not more, than successful ones. I think a lot of people realize that. There's all sorts of algorithms that, for various reasons, don't work. They look great in back tests, don't get me wrong. But everyone is, to borrow a Spanish saying, everyone's a general after the war, right? And so everyone sees that, hey, they're making, good amount of money, they're being successful. Well, great, they just cooked this up overnight and launched it to the world, and boom, it was done. But the reality is, for every single one of those algorithms that's successful, there's probably 100 that haven't made any money, right? Or at best have stayed even and performed along with the S&P or QQQ or whatever benchmark you like to use. But there's plenty of them that haven't and don't work, and it's a constant like experimental lab. So maybe to pull up the curtain a little bit, we have our main algorithm, what we're calling Teckel Capital. We call it the Athena Fund. That has been live for about 2.5 years now on live market data. So we're using real capital, we're deploying it, we're trading it. Back tests obviously look great, but back tests can always look great, just depends how you define it. But we've done really well in live testing as well. But behind that, we're testing probably 30 or 40 different algorithms as well in the background. And what that means is we're using live market data, live money, out of sample testing on all these algorithms, because at some point, your product's great, but it's like adding new features. If you think of this as like the beta version, well, you're going to
Yeah.
add more features that make the product better along as you go. So what we're doing is we're testing all this stuff in the background. We're looking for, uncorrelated returns. We're looking for divergence in performance. We're looking for downside risk protection. All these things from other algorithms that eventually will make it into the main portfolio, if you want to call it that, the main algorithm, and help augment kind of what we're doing and make ourselves even more robust, and, to borrow a term from Talib, anti-fragile. But I think there's a survivorship bias, to answer your question, and a lot of people think, gosh, this is easy, and let me tell you, it's not. It's not
Yeah.
as easy as it looks.
I think this is something that all founders know, because
Mhm.
even the most successful ones, they had to pivot. Like, they were in situations of, I die tomorrow, and they had this idea, they pivoted, and now they are multi-million businesses. And sometimes it's multiple pivots. I was reading Slack before it was Slack. They pivoted 15 times. It was something completely different. And Slack was their internal communication software that they built. So
Exactly.
that's insane. And so in your case, how did you get your first customers? It's more like B2C, or is institutions, enterprise? And did you have to do strong pivots to get where you are today?
So let me unpack the customer question first, and then we'll go to the pivot question. So, um, in terms of customers, like if we want to cloak this in the typical kind of venture capital terms, we are in what I would call the post friends and family seed phase. But this is a really unique thing to investment funds, and I'll explain why. So, for investment funds, it's typically, if you're starting from scratch and you don't have a huge track record, you're not a trader who's done really well on a desk at JP Morgan or whatever institution, you can take your book with you. If you are starting from scratch, you have two things to overcome. One is the initial capital fundraise, right? So you have to be able to raise and manage just a certain amount of money, call it $500,000 US, right? Then you have, and that's your B2C. So really that's talking to individuals that we know, people that we've met either professionally or personally, who have trust in us as founders to drive meaningful performance in the markets. Once you raise a certain amount of capital there, you start building your track record. Now your track record is just a history of how your performance is done, right? The point where you get to B2B, to the institutional that you're talking about, is at minimum. And this, I would say that the goalposts keep shifting higher and higher, but let's call it an at minimum. At minimum, you're having to manage at least about 1 to 2 million assets under management for a track record of at least 2 to 3 years. And I think that is a lot of people misunderstand the capital allocation process and think, you just go and knock on the door of the teachers union, and they'll give you some money, or the firemen's union, or a pension fund, or a sovereign wealth fund, and maybe in exceptional cases you might be lucky, have the right conversation, the right person, and they may be willing to risk a very small percentage of their fund and give you some money. But for the vast majority of people, you start B2C in those terms, and then you eventually move to institutional, but you have to build up that track record. You have to build up that credentialization, basically, for lack of a better term, of your ability to manage money. So right now, B2C, right now, call it the seed round, right? And we're still actively raising capital. I think the other thing that's unique about investment funds that's a little different from, like a product-based fundraise, is you don't typically do rounds in terms of like, I want to hit 500K for my seed, I want to hit 3 million For my post seed, I want to go to the Series A, B, C, etc. You're actually just constantly in a fundraising cycle because it's a double-edged sword. You raise money, but then, well, the product is the money, right? And so people take the money out. So you're constantly in a fundraising cycle of like raise enough to be successful and be able to support your own operations. But the more successful you are, the more likely, some people might want to take that money out and use other things, buying a house, buying a big purchase, whatever it may be.
Yeah, and I have a question about the liquidity of these funds.
Yeah.
How does it work? Like people can take out the funds whenever they want.
So every fund has like a different structure, and so you can put your own terms on it. The way that we have done it up until now is we lock up the funds for a full year, 65 days. And then after that, we're evaluating different withdrawal methods right now. So this is not baked. But generally what investors like to see is a certain amount of liquidity, right? If you say I'm going to lock your funds up and you can't withdraw them for 5 years, well, I mean, as an investor, that kind of makes you feel like, do I trust these guys for 5 years? I mean, that's a big ask. But usually what you do is you do like a lockup period. In this case, it's 365 days. And then you could do things like quarterly redemptions. So every quarter you could take out your money, you can make yourself liquid. And you could, as long as you give us enough advance notice, because you have to manage the markets, you can take that money out on a quarterly basis. And you can take out anywhere from 5% of it to 25% of it, etc.
All right, so that's amazing. So for the questions about the direction and pivots, well, it looks to me that the product is the same. What might have changed a lot are the assets you are investing in, right?
Yeah, I mean, so correct. And let me unpack the kind of pivot question a little bit. So I'll give you two examples of pivoting. One is like company structure, and one is the assets, to your point. So company structure. In the United States, there's a couple different types of funds that you can run, right? We're talking like legal entity structure. Where we're at right now is what we call it's basically, for lack of a better term, a friends and family fund. That means we're not charging any fees. We charge no fees to the investors, right? We're pre-revenue in a product sense. So while we're managing their money, we're not charging them to manage their money. Now, from a structure perspective, that is a simpler structure to set up. There are fewer obligations in terms of you as like a fund. Then at some point you have to make the decision to go what I would term like a full fat fund. So to turn it from being friends and family to being something that's more like a typical fund structure where you'd be charging fees. So a pivot we made was actually just this past July. We had thought in July, like earlier this month, we're going to go into that full fee structure. We're going to start charging fees. We're going to start making revenue off this product, etc., off Teckel Capital, right? What we decided was we were going to actually kick out the friends and family round until at least the end of this year. Part of that reasoning was based on market performance. It's been pretty shaky markets, all the tariff related discussions, some of the market data hasn't been particularly good. So we were in a solid place, but we weren't in a place where we wanted to say, we're going to start charging you on the money that you're managing with us. So we decided that we were going to kick that out. So structural perspective, that's like a pivot that we had to kind of take, right? Which was a decision that we had to make in the moment, right? Then from a asset kind of class perspective, what you were talking about, it's interesting because I don't remember exactly who said it, but the idea remains the same. It's really easy to make a lot of money on $10,000. I mean, it's really easy. You can make a lot of money on $10,000. It becomes really hard to make a lot of money on $100 million. And that's because every asset class has a certain level of market depth to it, right? There's only so much liquidity. There's only so many people trading it. If you don't have liquidity, functionally stuck in the position. You can't get out of that position if you're managing a lot of money. If you're managing a little amount of money, then getting in and out of positions really easy, right? I mean, a lot of tickers are going to have daily volume that you can get in and out, within
And
call it
actually,
a day or two. Yeah.
yeah, sorry to interrupt. That was going to be one of my questions, follow-up questions. When you manage enough money,
Mhm.
the transactions you make can affect the market. Like how do you plan for your strategy to be scalable? Or you need to come up with a complete different algorithm?
Yeah, I think that's a good question because it's really analogous to like a product question, right? If my back end isn't scalable, then my front end's going to suffer, right? If I get too many users, then suddenly, if I don't have, and sorry, I'm not super technical, but like let's say I'm running a server, in my room, and that's where all my customer data sits. If I'm not moving to an AWS or Google Cloud and be able to expand that backend infrastructure, well, guess what? My application is going to crash. It's going to be slow. It's going to reach limits. Customers are going to have, in the product sense, an unfavorable experience. It's pretty similar in capital markets, right? If you don't have sufficient liquidity on the instruments that you trade, well, your performance as a fund is going to suffer because you're not going to be able to get in and out of those instruments. And if you can't get in and out of those instruments, well, you can no longer perform. You probably won't be able to perform the way that you expect to. So, from a scalability standpoint, there's two elements of scalability, right? There's the scalability of the structure, which is setting yourself up as a fund, having the right third party administrator, the right accountants, the right auditors, the right legal in place that your fund's structure can scale. And so if you set it up correctly, you have all of that. Then there's the question you asked about the scalability of the strategy. And so when you're defining a strategy, it's great to trade, micro cap biotech stocks. You can make a lot of money, if you understand the market well. It's really hard to trade those once you're managing a lot of money because you're not going to have liquidity. So from the outset, the way we defined this algorithm, the way that we defined Athena, was to use highly liquid instruments because, yes, I could theoretically have done better on a smaller amount of money. And quite often when I was trading my own money, it wasn't millions and millions of dollars, then I was trading much smaller instruments. But as we framed this up, we made the acknowledgement that maybe the performance won't be 100% the same, but we can get 96, 97% of the performance with much more highly liquid instruments. So we've had that idea since the beginning. I think scalability is something that we've spent a lot of time working through. And then to go back to the conversation we had earlier, we're testing all these other algorithms in the background, right? Each one of those algorithms may become a percentage portion of the portfolio. If you want to imagine it as like, there's the main algorithm, which we're running now. Then there's 30 or 40 other algorithms that we're testing. Those 30 or 40 other algorithms, well, if you add those and they're trading different instruments, your liquidity pool in totality is getting bigger and bigger because you're trading different instruments, right? So as we continue to scale, yeah, I don't foresee any issues with scaling to 10, 15, 20, 100 million. But once you start getting beyond that point, well, you're really going to have to start considering both the instruments you're trading and how you trade them. Because it's not just the amount of instruments you trade, it's also how you trade them. Are you doing what they call banding a trade, which is where if your algorithm is saying buy, right, at a specific point, well, maybe you have buy plus 2%, buy minus 2%, and you start shifting in and out of those positions as you get around what you would call banding the trade. So there's like technical ways to do it, but there's also just the fundamental, is it liquid enough? So I hope that answered your question. I don't know if I did, but yeah, okay.
Thank you. And then I have a last question, and then we can go to, I want to ask you a lot about how you handle stress and how you do in a day-to-day basis. But before we jump into that, I'm wondering, because all these algorithms, they rely on technical analysis, right? So how do you protect, and maybe you tell me now, we read the news as well, right? Now with it. My question is, how do you protect this algorithm against, the world today is super shaky. Like there is a new war tomorrow, or the president is announcing tariffs, and the day after it's postponing the tariffs, and there are a lot of things happening, and they are affecting the market. So how do you handle that?
Yeah, and that's a great question. So let me pick up on your first point for a second. If all algorithms are technical analysis, the answer to that, my answer would be no. Not all algorithms are technical analysis, right? You've got algorithms that use sentiment analysis, to your point, like about the news. You've got algorithms that do certain types of, there's something called like the crack spread. The crack spread is basically the price differential between like refined oil and unrefined oil in basic terms, and how that relates to the price of oil. But there are a lot of different ways in which you can build. There's like pair trading. There's all sorts of different ways to build an algorithm. Technical analysis, there's detractors, and there's people who believe it's not true, and then there's people who believe that it is like the Bible. And you see all these like memes on Instagram with like 1,000 lines drawn on them, and they're like, yeah, the price is going to go to 10 million. You just have to wait for this line to hit. Our algorithm is not technical analysis based. It's based on macroeconomic indicators. So the way that we look at it is we take a longer term, and this will help answer your question too. We take a longer term view, right? If we had to just make, I don't know, call it 7% a year, right? Year over year. And we were a fund that was our function. 7% a year, very low drawdown, etc. Then we would probably do things like the crack spread. We tried pair trading. We tried different sorts of ways to kind of help smooth out those returns. But the way that we look at it is longer term macroeconomic cycles. So we look at the cycles and we say, okay, where do we believe the market, where do we have strong conviction the market's heading in the next, call it 50 days, 100 days, 200 days, etc. And then we use a couple of different strategies to kind of mitigate that risk. We use basically those macroeconomic indicators and different elements in our portfolio of how we actually construct it and how we use that to develop what we believe to be a longer term robust algorithm. So we're not like short term react, right? We don't have, to be very frankly, we don't have the infrastructure to be able to compete with the likes of a Citadel, or these guys are high frequency traders. We are not doing thousands and thousands of trades a day. We are trading probably 20 or somewhere between 15 and 30 times a year, right? So we're not as reactive to those cycles that you described. If there's, and hopefully there isn't, but if there's a new war starting or if there's tariffs released, we absorb those impacts because of the way that the algorithm is structured. But we encourage our investors, as we've had in every conversation, yes, we're locking your money up for a year. But if you want to be really successful, leave it with us for 2 or 3, because it takes time. It takes time to realize these gains. It takes time for this algorithm to do its work. It works through different longer term economic cycles. We need to go through those cycles to show you how well it works.
It makes sense. Yeah. Otherwise, bad timing can mean bad performance. That doesn't mean that the fund is not doing the right investments, right? How does a regular day looks in your calendar? Are you a 5 a.m. founder that goes for a run before starting the day?
Alan, I'll be honest, I have a lot of ambitions. I would love to be a 5 a.m. founder who wakes up and journals and then goes on a run and then does a workout and takes a cold plunge. That is not my lifestyle. Unfortunately, I've tried it. It doesn't work. Not for me, at least. Sure, you feel good, but I'm not a 5 a.m. founder. So I'm more towards that kind of night archetype rather than the early morning archetype. So where I find like sometimes my best ideas are very just random, right? I'll be in the supermarket on a Sunday, I'll be in like Mercadona equivalent, and I'll suddenly be like, yeah, we should actually test that. That's a pretty good idea. And I'll rush back to my computer once I'm done my grocery shopping, and then I'll go and test it, right? So I would say inspiration hits at different times for me, and quite often it's in like unexpected places. But my day typically, I'll start at 7:30, 8, kind of get the day started, and then usually I'll be in front of my usually about 12, 13 hours in front of my computer, obviously with breaks and things like that. But that's usually how I manage it. And then I'll work a bit on the weekends as well, just to there's urgent filing deadlines or things like tax or whatever it may be, right? I will tend to um, get those done maybe on Sunday or Saturday or whatever when I have a bit more time to sit and fill in what are very important forms. But yeah, I'm not a 5 a.m. guy. I'm sorry to disappoint you. I'm sure
No, no,
lots of
no.
people say they are, but I'm not. I will be honest. I am not a 5 a.m.
No, actually, I think the only thing we all founders have in common is that we end up putting a lot of hours. It
Yes.
doesn't matter when, I know other founders that work at nights. They wake up super late and it works for them. I need a routine. I need to wake up every day, go for a run, not at 5 a.m., but 6:30, something like that. Because and sometimes I have cycles that I stop doing that because I'm working too much that I can't even fit the run. And after a couple of months, I start figuring out that I'm sleeping more because I'm more tired. So I need to push myself to keep doing this run and having this routine. And that's what worked for me.
Well, I think you could argue that 6:30 in Spain is like 4:30 in America. So in a way,
Yeah,
you are a 4:30 founder, right? Everything's shifted by 2 hours. Everything breakfast 2 hours, lunch 2 hours, dinner 2 hours. So you are a 4:30 founder, really.
I like that. I'm going to use this argument. Cool. So, do you remember any kind of tough moments that you had to take tough decisions since you started that you want to share?
Yeah, yeah, tough decision. So it's interesting being like an algorithmic trader because the whole idea is that you're actually not making decisions, right? You're not day to day. It takes the human bias out of it, right? A lot of reasons that, in particular, like retail investors don't do well in the long term when they're trading is they're too emotionally invested, right? Bought a position, the position is not going the way that they think it's going to go, they sell out and they just take the loss, and they're not willing to see it through to the long term because they don't believe maybe they don't believe in their own conviction of what they bought. They just heard it was a good idea and they bought it. And think back to you want to talk about like emotional investing, think back to I think it was during COVID when people were investing in like the AMC cinemas and GameStop, right? To like meme stocks. And those were basically fueled entirely by people's emotions, right? I mean, the fundamental case at the beginning was that it was undervalued and it was a good stock. But then as more and more retail investors piled into it, it became just kind of like a hysteria of, this is going to go to the moon. I think GameStop to the moon was like the meme, right? And the whole idea of algorithmic trading is you're removing yourself from that hysteria, right? So I think from a trading perspective, there haven't been many hard decisions that we've had to make. I would say the hardest thing in this business is when things aren't going the way that you planned. So what I mean by that is, you raise all your money from investors and it's going well, but I remember that when we did our first round, if you want to call it that, it would be last July it was either June or July. I think it was July. And I remember right after that, the market took a pretty significant downwards turn. Not to the point where it was like shattering records or anything like that, but it took a tumble for sure. And you can imagine it's like getting new investors on and then having to say, hey, my product isn't working the way that I expected. Well, that forces some tough conversations, right? Now, luckily, being in the position we are, having mostly friends and family, we just said, listen, I mean, this is all part of it. It's not, if we were trying to sell you something that went up every single month and just had very consistent returns, then we'd probably be lying to you. That it's really hard to do that, at least in a meaningful way over the long term. So you have to trust in us. You have to trust in what we're doing. It shakes your foundational belief in your first couple of weeks. Suddenly, everyone's at minus 10, minus 15%. And you're like, yeah, that $10,000 you gave us, well, it's now kind of 8,500 and, just give us time. We'll build it up. And so, I mean, that speaks so much to like, in a way, kind of luck, right? It's when you launch, how you launch. And sometimes that luck can carry you and you can do really well out of it. And sometimes, like us, you get a little bit of bad luck. But if the product is good, then you can overcome it, right? If the algorithm is good, you can overcome it. And we've overcome it. But that is kind of, unfortunately, one of the harder moments that we've had launching this is actually not really the algorithm element, but it's like the people element, right? Dealing with the questions about why is this not going as well as I expected it to.
Yeah, I read something a while ago, and maybe you know the number, but it was something like the best investors, the ones with the best track record, average 10% per year in the last 20 years, things like that. They were in loss like 80% of the time. It's like the return doesn't necessarily mean that you've been positive, right? They're negative, but then it goes up.
Yeah, and I think depending on what type of investor you are, right? You can be a growth investor, a value investor, a quantitative investor. It's a bit like religion. You have your perspective on the way that markets work and the way that stocks work and companies work. And generally, people will subscribe to one view or one style over the other. And yeah, a lot of the very successful investors have entered the market at times that feel contrary. Think back to the housing crisis in the U.S. in like 07, 08, and the Big Short with Michael Burry. A lot of the times, you enter at a point where it feels very contrary to what the mainstream might believe. So the mainstream was like, oh, everything's fine. There's not going to be any defaults on loans. And then you take a risk, and then your position at first might look really bad because still the majority of the market is against you. But then if you have like fundamental conviction in what you're doing, then the upside to that is once the broader market realizes that that is the way things are heading or the way things are going, then suddenly you will benefit disproportionately because you had that early position, right? So to your point, I think a lot of successful investors can be contrarian, and a lot of those kind of successful fund managers over the years have been contrarian and done really well out of it. But that first month, 2 months, 3 months, they might look a little crazy. They might look like they've got an idea that's really left field, and people are probably wondering, is this going to work out? I want to redeem from the fund. I want to take my money out. I'm not sure if this is the right thing. But the people who stay and stick around for the longer term realize that if you can make calculated, risk appropriate bets, then it will be successful as long as that market movement actually happens. Right.
You mentioned you invest in different kind of assets. Can you share a bit more? It's like stocks, but is the fund investing in cryptos as well?
Yeah. So good question. You have like the world of assets to invest in, right? You can invest in individual stocks, you can invest in ETFs, gold, treasuries, bonds, crypto, you name it. Like you can invest in whatever you want. We don't invest in crypto right now. That's not something that we have a position in. One, because crypto is a whole world. Like you have to really understand all of the tokens, all of the platforms, the layer 1, layer 2, layer 3, the protocols, how things are built, what has real applicability in that ecosystem. So right now, we'll leave crypto alone. Right now. Now, might come back in the future. There's some attraction there, certainly from the uncorrelated returns aspect. There's some benefit there, and we are testing. I'll be very clear. We are testing it. It's not part of it now. We are testing the applicability of crypto in our algorithms to see if it can provide similar returns that are less correlated with the market overall to help minimize our drawdown risk, but still keep our returns at the level that we expect them. So we're testing it, but it's not in the algorithm yet. I'll put it that way.
Yeah. Yeah, now it looks like institutional money is starting to go to cryptos. There is this Federal Reserve proposal that still needs to pass and get approved, but it looks promising.
I think there's a lot of institutional acceptance to crypto coming out now. I mean, you had all the Bitcoin ETFs launching a few years back now, and a lot of asset management companies are now taking it very seriously. You asked me earlier in the conversation, you'd asked me, a bit about my background. I'd shared that I lived in Spain. When I was in Spain, I'd actually worked in a kind of crypto company, right? So I had early exposure to it, and in many ways, part of my love of trading came from that early exposure. What we're doing now is more focused on ETFs. So we use ETFs to trade. We don't trade individual stock tickers. We could theoretically recreate our performance by what they call direct investing rather than ETF investing. But we use ETFs, and the reason we use ETFs is back to the liquidity question of are these things liquid enough to trade? So we trade highly liquid ETFs, and that's pretty much all we trade. We don't really trade much else. The temptation of adding in other asset classes as you grow, of course, for one, liquidity, but two, just from a, call it, downside protection perspective, of course, is there. And that's part of what we're testing. But to answer your question directly, we're pretty much just trading ETFs.
Maybe now I'm thinking about the future. It can be a different fund, right? Because if you're doing great with ETFs, why not keeping it like that and have a new fund with a different risk profile, maybe? Have you thought about that?
Yeah, I think so. Yes, definitely thought about it. And I think to your question of, launching future funds, and we talked about the structure a little bit before. So the friends and family versus the full fat, right? So with each subsequent fund that you release or launch, you have the same or similar levels of costs associated. So you've got your third-party administrator who independently calculates all of your NAV. You've got your audit and accounting team who obviously do all your accounting for your taxes, etc., but will also audit, right? A third-party auditor in addition to a third-party admin. And then you have all the legal stuff behind that, right? So you got all the lawyers, etc. Every fund you launch, you have to have those three building blocks, put it that way. Cost is associated with each fund you launch. So if we were to launch a fund that had a lower risk profile, our cost would, it's not exactly linear, but our cost would be something approximate to 1.8x what it costs now.
Yeah, I didn't know that. I thought it was like a company launching a new product, but it's like launching a new company.
Okay. It's launching a new company. It basically is launching a new company. Yeah, I mean, maybe bigger asset management places have a way around it, but it is essentially like launching a new company when you're at our size. Yeah.
Got it. And now thinking about the future, I think we're living a technological revolution now with AI. So what trend do you think most people are underestimating?
Yeah, I mean, I think a lot of people will talk about AI, attraction is the buzzword of the moment, right? And AI certainly has its place, right? Its ability to go through a ton of data and give you answers with agentic AI, etc. I mean, that is, don't get me wrong, absolutely amazing. And I think that there's a lot of potential there for its application to capital markets, where I think that maybe some people overestimate its ability is there are people who believe markets are rational, things are priced in, therefore it's easy to use data to completely guide your strategy. Oftentimes what happens is, and this is like a data science concept, the concept of overfitting, right? you are too overfit on historical data, that on a go forward basis, because you're using that historical data too closely, it's actually not going to work live, as it were. It's not going to work in the markets. And I think we're at a point now with AI where if you go to ChatGPT, and I've seen examples of this around on different publications, but if you go to ChatGPT, you can, if you give it the right prompt and you engineer the prompt correctly, it can probably pick really good stocks for you, and you can probably do better than just the indices, right? However, it all comes down to prompt engineering and your ability to understand capital markets. And if you just ask it, I want to make a profitable trading strategy, it'll say, sure, let me make you a profitable trading strategy. You are, so brilliant. And then what ends up happening is the profitable trading strategy it comes out with, was profitable looking back, but then going forward, it's not going to be profitable. So, I think the technology that I am excited about is AI and its applicability in capital markets, but I don't think it's quite where it needs to be for at least the type of trading that we're doing. I think it's probably useful for identifying, high growth stocks, identifying, value stocks, etc. But if you layer in all these different elements that you need it to be able to do, it's not even close to your ability to dictate. And that goes back to the markets are irrational, right? It's not all priced in. It's not all easy to predict where things are going. There is a rationality. There's human emotion to it. There's ebbs and flows of capital. There's passive investing. There's people, buying and selling every day. And that it is not rational. It's not entirely rational. So it's really hard for something that is fundamentally built on rationality, or at least elements of rationality, to be able to capture that.
Makes sense. So you think AI it's going to help as an assistant or giving advice or tips?
Yeah, if I'm like if I'm investing a stock as like an equity research guy, and I want to put together a very quick kind of due diligence on the stock, key competitors, market size, the pricing, if it's, where's the cash, where's the value of the stock heading, then I think that it has applicability there, and even now has applicability there. I think where it struggles is imagining kind of the whole picture, right? It can help you pick individual stocks. It might be able to help you assemble like a portfolio of 15 or 20 stocks, or however many you ask it for, really. And might be able to help you research them, etc. But because inherently most of the data that it's using is all backwards looking, right? It's using all the reports and available information it can on the internet. It has a hard time thinking about the forward looking, and it might tell me that if I would go back to, I don't know, the dot-com crash or whatever, it might say America Online was a great investment. Well, we all know how AOL went. It didn't go too hot for many people. So, elements of that, I think that backwards looking bias are going to make like limited applicability, but I think it has like that, to your point, like that assistant nature that could be helpful.
How do you define success?
So, how do I define success? I mean, there's like internal success and external success. Internal is obviously like your own ability to say, I'm successful. External is other people's perception of you being successful. I think there's two different types of successful, right?
I am thinking about the internal one. When you say in life, okay, I made it.
You made it. You can do what you want to do. You don't have to ask anyone for permission for it. You have your ability to kind of self-direct yourself. And if you want to go and, play golf on a Tuesday morning, go play golf on a Tuesday morning, right? I think a lot of that, my conception of success is intrinsically tied with the idea of like, personal freedom and being able to do what you want on your terms at your time. That's what I would view as success, because you're not dependent on external factors to be able to grant you the ability to have that personal freedom and that flexibility.
And imagine you're 22 years old, comes to your office and asks for advice. What will you tell him?
The first thing that I would tell, at least my 22-year-old self, you don't know everything. So you got to learn. And learning will take time and experience. But as long as you can do the basics right, and I'll tell you basically what I tell, every summer we get interns, and they're all kind of 21 or 22, right? They're college age, and they're maybe in their second to last year of college, and this is their summer internship. I said, what I usually say to them is, it's actually pretty easy to be a good intern, right? It's not really, really difficult. Actually, all you have to do is do what you say you're going to do it on time, and ask if you have any questions. That's it. I don't want you to sit there and spin on a document or spin on a LBO model or whatever for an infinite amount of time, because I can help you do that. And all you have to do is ask me. So 22-year-old goes back to, you don't know everything. There's no expectation that you're going to know everything. You're 22, right? I'm still learning every single day, 10 years on. I'm still learning new things every day. So where's the expectation that you should know everything? And where does that come out of? So just do what you say you're going to do it on time, and just ask for help if you need it, because that's what we're there for. People with more experience than you, it's part of our role is helping you be successful, right? And if you ask, we're almost all willing to spend time with you and help you do it.
Yeah, I completely agree. I have the feeling that over time, when I was in school, in university, I had this feeling that I could do better than anybody else, right? I had this drive, and over time, you realize that, okay, now I'm 34, I'm learning new things every day, especially when you build something, because things change at a super, super fast pace. So yeah, I fully agree.
Well, I think to your point, right? I think, up until you're 22, right, probably from the age of, like, call it 5 or 6 to 22, you're in school, kind of built around a system that if you learn something that they're teaching you and you take a test, you do well in that test, you get a good grade. You get a good grade, you probably get a good internship. So it's very, up until that point, it's like quite a rigid system of how you define success, right? You asked me how to define success. It's a very rigid system of how you define success. Someone who's successful does well at school, does well in the test, does well in the subjects, goes to a good university, gets a good internship, right? That is success up until that point. Once you emerge from that very rigid, a square is a square and a circle is a circle system, into something like the professional world, where I think the challenge becomes much harder, because there's a lot of, it's not as given to you as school is or university is. It's kind of self-determination at that point. Once you have that level of, like, self-determination, I think that's where it becomes more difficult to, A, define what success means to you personally, but B, have that external success that people see, because no one's going to sit you down and tell you, this is how you do a career. This is how you, sure, there's plenty of books and there's podcasts and, etc. But no one's going to, it's not a one size fits all anymore. It's suddenly a much wider, diverse system. So to be successful, well, suddenly you have to determine that for yourself, and it's no longer kind of handed to you. So that's why you and I both learn new things every day, because guess what? It's not a process that just stops and you're suddenly done. It's, in fact, learning new things every day. Curiosity is probably the most important part of that whole process.
Yeah, and finding purpose.
Yeah.
It's a tough one. I know people that achieve financial freedom, and that was the purpose. And when they get there, they're lost. Like, they need to, find something else. If you had to send a message to your investors, what would this message be?
Send a message. Well, we talk to them pretty often. I will let you know that. So we do send out, monthly reports and everything. So we do talk to them relatively often. But I think the same message that we usually end those reports with is the most important message, which is, we remain committed to the way that we are investing your money. We have a longer term solution that takes a mid to longer term view of how to be successful in capital markets. that takes time to realize. When we realize it, we'll all be successful, we'll all be happy. But you need to give us the time and the ability to invest your money how we believe it should be invested. Otherwise, if you look at this as a short-term venture, then this might not be successful for you. So take the long-term view. When in doubt, zoom out and believe that we've constructed something here that is both robust, but also meaningful in the way that it performs. So we're going to continue to be diligent, do what we need to do by the algorithm, and that's going to make us collectively more successful.
What do you think is your superpower as a founder?
My superpower as a founder, I think the conversation we just had on the 22-year-old self, right? I think you need to retain a little bit of that 22-year-old self-confidence. Don't lose that, right? But you also need to retain a certain level of curiosity. And you're only going to be successful if you're curious, if you want to find out new industries, new things, experiment, there's a phrase they use in the US, it's maybe they use in other countries as well, but throw spaghetti against the wall and see what sticks, right? You have to have that curiosity to be able to try a lot of different things. And I think the superpower that, if I were to define myself as having a superpower, I think the superpower, right, is being curious and retaining enough self-confidence to have conviction that I'm right when I believe I'm. Most of the time, not all the time, most of the time, that tends to be rewarded. And then I'm the technical founder, and then you got Matteo, who's the other founder. And if I were to comment on his superpower, it's very different from mine. And I think to be able to have two people with different superpowers is what makes a great founding team. His superpower is that, ability to build personal relationships, that ability to really understand people, understand, what their priorities are and how those might shift over time. And he's got that superpower that it's not saying that I don't have some of that, but he certainly has that ability to really delve deep into conversations with people, understand them, build relationships. And I think that those two superpowers together, we want to call it like that, make a good founding team. And I think a lot of people overlook that in their founding partner. They look for a complementary skill set rather than they look for a skill set that's the same as theirs rather than a complementary one, better said. So I think that is probably my superpower, if you want to put it that way.
So conviction, determination, and not
curiosity.
Curiosity. And something you mentioned before, never stop learning. What stood out in this conversation for me was that at the end, starting a fund or starting a product startup is not so different. We both have the similar challenges, and definitely as a founder, I think we need to have the same skills or similar skills. At the end, you're pitching to investors that are customers at the same time. We are pitching customers and investors separately. And we need to be consistent. We need to pivot when something doesn't work. We need to kind of find product market fit in a different way. And thank you very much.
Thanks for having me. And the parallels between a product-based company and investment-based company, they're actually very similar. You've got customers, product market fit, scaling, growth, all of those are the same thing because fundamentally they're both businesses, right? So no, it's been a real pleasure to have this conversation with you, Alan, and I hope that you continue to be successful with the rest of your podcast guests. I look forward to listening to a lot more episodes.
Thank you very much. The pleasure is mine, and have a great day.
All right, you too. Bye.